Charting 101. We're going to be doing support and resistance here. Um, and this is really the primary way that I take trades. Um, Probably 75% of the trades I take are based off of action around support and resistance. So I guess before I hop into this, are there any questions about, really what we're trying to accomplish with support and resistance? Like, is anybody not familiar with what support and resistance actually is? All right. All right, cool. So we're going to go through basics here, how to identify them, what to expect, charting methods, time frames, and kind of making it easy for yourself and applying all this to your trading. So you're not just blindly taking trades. So the basics, why chart support and resistance? So support and resistance measures levels that we expect as retail traders for price action to slow down, reverse, reject. So using prior charting, we can predict what the ticker is going to do at these key levels. So fundamentally implied with support and resistance is that a strong support implies that institutional buyers, the people who drive the price action behind everything, consider a fair value for that stock. So if we take Apple, for example, we see that Apple's approaching 150, and we've seen in the past that Apple has treated $150 per share as an inflection point. We know that institutional buyers are all of a sudden considering that Apple at 150 is a good buy, and good buying, in large mass causes the stock price to go up. And the converse applies for resistance. It, implies that as Apple reaches, let's say, 175, institutional buyers are thinking that the company is now overvalued and they're going to start selling at that price. So using prior price action at certain levels, it lets you identify support and resistance. As you have these key levels charted, you can observe these clear response to these levels, and you can establish a trade plan based off of this. So when we're identifying these charts, these support resistances, we're looking for multiple touches. When I say that, if you see that at one point in time it might have inflected that, again, using Apple as an example, 165, that doesn't necessarily confirm that that's a strong support. If it happened twice at 165, then all of a sudden we can start to think, hey, 165 might be where institutional buyers are thinking, hey, this is a good value. And when we see multiple touches on both sides of it, so you see trend lines or support and resistance, where it's treating it as a support, and then all of a sudden it flips to resistance, that becomes fundamentally stronger. We know that it is more relevant as a support or resistance. So what to expect? With support, as a stock approaches the support level, we expect price action to slow down, meaning the length of candle bodies are going to start to shorten. We're going to expect to see on the bottom of the chart, we should be watching volumes start to taper off before watching those candles start to touch. And same for resistance in the opposite direction. We're expecting price action to slow down. The length of those candle bodies are going to start to shorten. We're going to watch volume taper off, and then we're going to watch for a rejection. And these are really priming us for those entry points. So volume and candle bodies, as mentioned before, we have two very easily accessible tools. And that's going to be watching, again, the length of those candle bodies and volume. If you're watching for a ticker to approach a support and you see that volume is not tapering off, if it's increasing, it's reasonable to expect that resistance is not going to hold. And same with the candle bodies. If they're increasing in length, or if they're not getting shorter as you're approaching either support or resistance, it's reasonable to expect that it's not going to hold, and it will break through or break down. So there's three types of touches on support and resistance, and there's been some contention over time about whether you use candle bodies or whether you use wicks. So with these three types of touches, they're going to be called Pearson reversal, or I forget what the other term is, but it's what I'm going to refer to as Pearson reversal. You've got contact pins or contact points, and then you've got breakouts and breakdowns. So when I was doing this, I think on Thursday, I took the live 6-minute view on SPY, and well, it held up quite well, but we're going to see that right now. So on the first here, we have, you can see my mouse here. We've got SPY action coming up here. We've got it coming down. If you're looking at volume, it's starting to come down from that buying action. So you're going to see these contact pins. You've got a pierce and reversal on elevated volume, and we come back down. We've got another touch here, contact pin, and we finally have another contact pin before a breakout. All the way down here, we've got, I'm pointing with my finger, we've got decreasing volume as we see this breakdown. We have increasing volume, and then a breakout candle before it retests and moves on. So these are all Pearson reversal, Pearson reversal. We've got a breakout candle. So these are all things to watch for. You know, I could have pulled a stock image, and it would have been probably prettier to look at. But this is what the real life support and resistance is going to look like. So moving on, and I'm just going to try to blow through this PowerPoint real quick here, because the more important thing is seeing how to do it. So one of the things I've discussed is you can chart on multiple time frames, right? And each of these has a different value when looking at a chart live. You know, if you're charting on the 1 week chart and you find multiple touches for a support or resistance, that's considered to be a more substantive support or resistance or strong supports. And the same applies for multiple touches. The more touches there are for that line, the more relevant it is. So I typically start on the 1 week, and I'll go to the 1 day, and the 390 minute, and the 195. And as you get incrementally smaller, those supports and resistances become not less relevant necessarily, but not as strong. So support and resistance that you draw on the 6-minute chart is going to have a lot less weight to institutional buyers than one on the 1 day is. So we're going to go ahead and actually apply this. We're going to pull up a chart here. I'm going to pull up my trading view real quick. So this is my very messy chart, and this all makes sense to me, but it may not make sense to you, so let's pull up something a little easier to look at. All right, so we've got SPY on the 1 week chart. Are there any requests? I mean, SPY is kind of overdone, and it's not necessarily a great indicator because it takes a lot of other things into weight. Are there any requests for a particular ticker we want to use? I mean, I use Apple as an example, and for me, Apple behaves beautifully for technicals. Coin, TQQQ, TNA, Apple. All right, well, let's start with Apple. How about I actually start over here? So Apple on the 1 week chart. I'm going to delete this. So when charting, for me, I start on the 1 week, and I'll go all the way back down to price levels you'll never think you'll touch again, but you very well might. You know, we never thought we'd see 130 on Apple again, right? But we did. So charting down to these levels is valuable. You know, it has a lot, especially if there's a split. Like with Google and Amazon, with these recent splits, I had those charts from all the way back. And if you draw the lines, you know, when it split, all of a sudden those levels started playing out again. I didn't rechart it. So with Apple, we've pulled up the 1 week here. And with the 1 week, you're not necessarily going to get a lot of great touches, but you will see some. And something to keep in mind is that when you're drawing these supports or resistances on larger time frames, usually they can be refined on the shorter time frames. So on the 1 week chart here, there aren't a lot of great touches. If I look at here, I'll explain my coloring convention in a second. So we have here, we have a Pearson reversal, We have a breakout and ultimately a weekly rejection of that breakout. So we know that this, let's say 135.41 line is a support and resistance. We have ultimately what played out to be a rejection here. And these are, mind you, these are 1 week, so it's not that particularly it's not that particularly fine on the 1 week. But we know that we're essentially saying Pearson reversal, rejection, rejection, Pearson reversal, finally a breakout, and we came close but not quite, so there's probably something to be looking for right here. Pearson reversal. So even after we had this colossal downside in the market, we still saw this 135 hold up on the weekly. So something I'm going to point out here before I go too far is I use a coloring and dashed convention, which you're free to adopt. You're free to do whatever you'd like. If I have lots of the same color, so if I'm using this dark maroon color, right? I know that if I pull up a chart on any time frame, I know that when I look to the right and I see a dark maroon color, I know that's a weekly support, and I know that's a very strong support. I know that's something I should be paying lots of attention to. And I'm not going to know that I drew it on the 1 week if I'm in a 6-minute chart. I'm not going to know what to look for there. It doesn't mean anything. So using this coloring convention going forward makes charting a lot easier. So for me, 1 week charts, bottom right, that's the darkest color I can find. It's this dark maroon color. When I flip to the daily chart, I'm going to change my coloring convention. I'm going to use a light purple. So now, I didn't mean to change that color. So now all of a sudden when I'm drawing supports and resistances on the daily, I know that light purple, all of a sudden that's going to be daily supports. And again, daily is going to be a very strong support. Those are really substantial numbers that you're looking for. So the other thing to keep in mind when drawing supports and resistances is if you're zoomed way out, it's going to be really tough to identify all these fine touches. So if you zoom in and then you pull the chart back, it's going to be a lot easier to get more accurate lines placed. So again, going through here, I don't see a lot of clean touches, but what I do see are some close approximations to price points where the stock is reacting. And again, this is going to be more common on the weekly, the daily, perhaps even the 390, and I'll explain that in a second, but the 390 minute. On these larger time frames, you may not get precise touches, but what you're going to see is approximate, and it would be, if you wanted to draw it as supply and demand zones, you could do that. But you're going to see approximations of price, right? So, and something to be mindful of is if I draw, let's say I draw this line here, 122.6, right? And I'm going to change that color to light purple. So if I see the price coming down to 122.6, it may not have an exact touch to 122.6. It's a general approximation. So we as retail traders have no advantage of algorithms or no advantage of having hundreds of millions of dollars, if not billions of dollars, to throw at these stocks. So we have to anticipate what institutional money is going to do. So in this case, we're looking at right here on the daily chart, it didn't come down to 122.6. It came down to 123.16. That's a close approximation. If you're trading on a daily chart, that's close enough. What we're looking at here is we see it doesn't have a lot of relevance here. We do have a Pearson rejection here. We have ultimately a breakout and a rejection of that breakout here. We have a point touch here. So what we're seeing is that it's stabilized. Apple stabilized at this 122.6 level. Same here. It's stabilized around 122.6. And then we have several fairly clean touches. And if we go forward, it never really approached that level. It held this weekly level much better. So we can use that again as a close approximation of price. And that's going to be the general expectation on these larger time frames. 135.6, 122.6. And you could probably pull a lot more off of this. I'd be comfortable placing a support right here. We see that 149.9. We had a couple of rejections here. You know, if I zoom way in, I can probably refine this a little better. So we have fairly clean touches here. We have breakouts here. What I'm trying to highlight again, and if I'm blowing over this, please stop me. Please put in chat. What we're looking for is these price responses. We have a price response here, a response here, a couple breakouts here. But again, this is really kind of validating that we have a breakout here, and ultimately it broke down. More touches here. So it's showing that there is some value to this 149.97. And again, it may or may not be useful this low on the Apple chart, but we'll get there. So again, zooming in, and we could continue to draw more lines, but I want to kind of get through this process of refinement. So going to the 390, using I personally always chart with extended trading hours on rather than regular trading hours. And the reason being that you may see gaps that aren't necessarily there because of pre-market or after hours action. And that'll be highlighted in several other tickers. But going to the 390-minute chart, which is the equivalent of the 8-hour chart. And the reason I don't use 8-hour, 4-hour, 2-hour, 1 hour is a trading day is not 8 hours. A trading day is 390 minutes. And what that means is that a 4-hour chart, which we expect to essentially represent 1/2 of a trading day, 4 hours is not 1/2 of a trading day. 195 minutes is half of a trading day. So all the charting timeframes that I use are a byproduct of the fact that a trading day is 390 minutes. Anyhow, so going forward, going to the 390-minute chart, we can see that, okay, 122 was fairly close, but there are some other fairly relevant numbers here. We've got 118.86. Again, going with the numbering convention or the coloring convention, I'm going to go to an even lighter color. So I know that when I zoom into my charts, the lighter the color, the shorter the time frame. And these, again, this coloring convention may not make sense to you. You can choose whatever you'd like. This just makes sense to me. The darker the time frame, or the darker the line, the higher the time frame. Again, using whatever convention you want. So here at 118.86, we see that, again, it's not perfect. It's an approximation. But we're seeing multiple touches. So on this 390-minute candle back here, you got to zoom way back. We have what happens to be a pierce, and it doesn't quite reject, but we see that this next candle does have a pin touch here before it breaks out. So, and again, this is more validated by this next candle here, which came up and eventually came down. So we're seeing that this 118.86 has quite a few touches over time before ultimately moving beyond. And again, after it broke out to 145, it came back down and it once again used this 118.86 approximation. And I'm not going to draw every line on here, but hopefully you're getting a sense of what am I looking for? I'm looking for these major touches, and you're trying to refine it over time. And we can do the same thing on the 195-minute chart, where I'm going to have to, yep. So if we go to the 195 here, and what's interesting is that if you go to the daily chart, you might see, okay, there's a trend here to some extent, but it's really difficult to identify what that trend might be doing. And on the 390, it's not necessarily as clear, but if you come to the 195 and the 97 are where I typically try to identify trends, because that's typically you're getting a more macro vision of what the stock is doing, but you're not too obtuse where you're going to miss these little details about a trend. So you could pull up a trend line across that, but that's for different. Sorry, different time. So if we're looking at here, let's place a chart, place a line. And for me, 195s are always orange. So we're seeing some close touches here, right? We have a pin touch here, we got a pin touch here. But we know this is a fairly substantial line to keep in mind because we've got 1, 2, 3, 4, 5, 6 touches on that line. So if we watch Apple come down, it is reasonable to expect that somewhere in this 151 to 149.9 range should be where we would be looking for it to bounce if it were to come down. And going to the 97 minute, and we can keep on applying this over time. But hopefully, you've kind of gotten the idea that what am I looking for? Is this a good line? Over here, we don't see a lot of price action necessarily at this line. But going forward, we see that we've got 1, 2, 3, 4, 5, 6, 7, 8. That's quite a few touches there. And again, going by my personal coloring convention, I'm going to go to a lighter yellow. And I should probably check what chat is saying. Request, I would love to know which indicators you're using and how you set the options, which membership level you recommend, and how you're drawing on charts when okay, so when using TradingView, I think I have the second tier. I don't have the Ultimate Pro plan or whatever it is. I think there's 3 tiers, like let's call it basic, intermediate, and advanced. I've got the intermediate, and the only thing I'm losing out on with the advanced would be the ability to pull up 8. I believe that's, yeah. So if I try to pull up 8, it only lets me pull up 4. Yep. Or I may not have a large enough monitor. But it also doesn't allow me to, I can't publish scripts. So either the low or the intermediate package is really all you need for TradingView. As for using some of these features that I'm probably blowing through, Alt-H will apply a line, a horizontal line. Alt-V will apply a vertical line. So those are just your hotkeys there for kind of applying support and resistance. And
I also recommend grabbing a little bit some of the real-time data.
Yes. When you're setting up your subscription to TradingView, you can get CBOE, NYSE, and NASDAQ, which are pretty much the 3 that you should be looking for real-time data. So you'll see, if you look over to my right, ES says a D, and so does VIX. That's delayed data. I just don't necessarily, I don't trade ES, I don't trade VIX, so I don't need that live data. But everything else like NYSE, NASDAQ, all that stuff is live. Is that what you're going to say here?
If you go with the free data, it's not super delayed. I think it's delayed by like a minute. Maybe.
I think it's 1 minute.
But it reads the data from a different source, and so sometimes the candles can be slightly they go just slightly different from real time data.
Yeah, if you're doing any type of day trading, it's worth spending. I think it's $2 a month.
Yeah, something like that.
Yeah, HDark, it might be delayed by 15. It is delayed somewhat, but
futures is delayed by 15. Real market data is delayed by a minute, but it's also not the exact real time data. So it's delayed by a minute, but it's also like slightly off.
Right.
They use like a slightly different data source. But yeah, so $2 a month, you should definitely get that. You're gonna get the extra options anyways.
Right, and speaking of TradingView, if you are not a member, every year for Black Friday they have a sale, and it's I think 50% off if you sign up on that Black Friday sale. If you're already a member, you can renew on Black Friday, and it's a prorated extension. So if you have 90 days left and you renew on Black Friday with that Black Friday promotion, you just end up getting an additional 365 days. So you'll get 365 plus 90. For me, it's well worth signing up and then just renewing on that date.
Yeah, and TOS does offer real-time data on futures though, so that's what I use. Because TradingView charges a grip of money for futures data.
So Haney, the difference between 1 minute, 5 minute, and 15 minute. We'll pull up here. Let's go to so I trade again on 3 minute, 16 minute, 18 minute, 49 minute. The 6 minutes typically what I'll be day trading on. It gives me enough information as to what price action is doing, but it's not too noisy. If I go down to something like 3 minute, or if I go to, I think with the pro version you can do like 1 second data too. Yeah. So that top tier subscription will let you get up to 1 second, I guess, which would be very noisy. But for me, watching price action on a 1 minute chart is very noisy. It's really difficult to focus on what's going on when you have a new candle forming every minute. It's very difficult for me personally to trade. And I've tried. It's just a lot. It's a lot of information. You're going to start to see things form that aren't really there. You know, I might be looking at this going, oh, look, I see a support here or a trend here. I see a cup and handle forming. And that's not really the case. So 6 minute for me is fine enough. And if I really want to see something happening live, I'm looking for a really quick scalp, the 3 minute might be fine. And if you see something forming, let's say you say like a trend forming, you can always validate it on a higher time frame. So if I'm not sure, if I'm watching the 6 minute and I think, oh, well, I'm going to plop a line here. If I see a support here, oh, I'm pretty sure I see a breakdown happening on the 6 minute. Well, I can validate it on, okay, what I'm really seeing is a Pearson reject. You know, I'm not seeing a total breakdown at 172.08. So validating on those higher time frames, and I'm not suggesting you go to a 390 minute for day trading, but if you go to an 18 minute or even a 49 minute perhaps, it really lets you say what's happening here, from a larger perspective, what's happening. Question: if you're looking for longer plays, are you typically looking at longer time frames? Yes, that's exactly it, Glitterbeard. So when I'm looking at swings, which I didn't really plan on covering in this session, economic data, yes, and you're looking at like a daily chart for swing entries, which is something I can get into if you all would like. I mean, I have a method for swing entries that has worked very well for me. And it may or may not work for you, but it's something that you got to be patient with. And I think I was discussing with Jen on Friday about a Dow short that we had entered, and there's a reason for that. Okay, well, swing entries we can do. So we're gonna I'll pull up the Dow chart. So using Dow, well, if it loads. So there are two reasons that there's two different types of candles that I use. These are called traditional candles, you know, your conventional candle, conventional Japanese trading candles. And then there's Heikin Ashi. Heikin Ashi does a really good job at highlighting what is the stock doing from a larger perspective, what's the stock doing, and what's that trend. So it's, you know, looking at this is very apparent what the stock is doing. It's obviously in a downtrend. But I look at it with traditional channels, it kind of looks like we might have a reversal here, and ultimately we don't, and it gets very noisy in this area. So if you use Heikin Ashi, which if you're using TradingView, you know, you can just choose your bar style. You've got all sorts of different bar styles. I have these two highlighted, just traditional candles and Heikin Ashi. So pulling up Heikin Ashi, this becomes very obvious. And I'm going to I have a bunch of presets up here. My swing trading section is right here. It's the L. But the two indicators I have on this, I have Heikin Ashi and I've got stochastic RSI. And if you're unfamiliar with TradingView, all you have to do is you click on indicators, look up stochastic RSI. It should be the pre-built one. There's a bunch of, so if you look at indicators on TradingView, you'll see that there's people can publish their own. And each one might have little different things they've coded in with PineScript. I have no clue what this one looks like. Okay, so this is the one that somebody else published, and it's showing something. You know, it's showing either reversals or it's trying to show entry ideas. I just go with the pre-built TradingView stochastic RSI. So again, it'll be the one that pops up top. This is their technicals versus community scripts. Their technical stochastic RSI. So the stochastic RSI is very close to traditional RSI, except it's got a K band and I'm going to say R band. But essentially you're seeing two lines down here, right? You see a blue line and an orange line. And again, you can customize that if you're colorblind or if you struggle with orange and blue. But what we're looking for is using, on the daily chart, using Heiken Ashi candles and stochastic RSI, we're looking for a couple of things. We're looking for a trend. We have a trend. We're looking for a printed daily doji, and we're looking for a reversal on the stochastic RSI. So the ideal entry that I had found is we have a clear uptrend followed by some, what we're seeing is, I'm going to call this buyer indecision or seller indecision. So printing these daily dojis means that there's plenty of, and you have short candles, which again is good. And we're going to call this a spinning top versus a morning star. We're seeing a fairly short Heiken Ashi candle, which means there's some buying and some selling, and it's met with lower daily volume. We see what seems to be a breakdown of that. However, we're seeing it coming on lower volume. And then on low volume, we start to develop a selling daily doji that is paired with a high and crossing over stochastic RSI. So we have a clear uptrend. We're seeing some buyer and seller indecision. We've printed our daily doji. We see it ultimately became on a selling day, and we see that it's on lower volume with high and crossing over stochastic RSI. This indicates that we are preparing for a sell-off. So how do we know this? Well, and you're not always going to get premier entries of this. If you look here, we had this, but we have the high and crossing over RSI. We don't really get the volume confirmation, but we do ultimately see trend met by indecision on buyers and sellers. We see high and crossing over RSI. And what we're seeing here is, okay, we missed this. We're getting confirmation of that, the reversal in pattern. So you're going to see this through, and again, you're not always going to meet it. We didn't really get that daily doji, and that's the big part of this, is the daily doji paired with high and crossing over stochastic RSI. We didn't really get that flag here, so we would have missed this swing. But you'll see it with plenty of it. We'll pull up, the crowd favorite, Apple. So how do we know? We have high and crossing over stochastic RSI. What we got a daily doji met by confirmation, but we had a rejection, which is why it's important to have this with your support and resistance, because it bounced on support before we get yet another high, and it's already crossed over at this point. So this might not have been an ideal entry, but we're getting confirmation of that entry here. And there, again, this is not a perfect method. It is a very successful method when you get all the indications, and you got to kind of dig around for some of this, kind of back testing it. You're not going to you didn't really get confirmation here until you got this breakdown and it's eventually diverging. You got to pick around with this. You're not always going to get perfect flags, but you see here, what do we have? We have daily doji. We have essentially a conflicting candle here. Before we get breaking down, we're seeing that the stochastic RSI is high. It has crossed over and it's starting to diverge before it comes down. We have a daily doji followed by an uptrend. So now what we're looking at is conflicting information. We have a selling candle. We have a daily doji, but now we have a downtrend, but stochastic RSI is low. So this method does not indicate that we have a good entry until we come all the way down here. So we've printed a daily doji, we've printed low and crossing over RSI, and it starts to diverge here. This would have been your entry for a long swing to the upside. We have low crossing over RSI, we have a daily doji. We have confirmation of that entry, and then we have take your profits. So this is something that it's worth kind of testing if you can see it on your own. Here's another one. We have high and crossing over our, daily doji. Really another daily doji. So we've got some buyer indecision. High and crossing over RSI. And then we have our divergence. We have confirmation of the downtrend. Confirmation of the downtrend before we get low and crossing over RSI with a daily doji. Right to the upside. They're great cheat sheets, just the candlestick. Price action at the end of March comparison was a tip for me then. Sorry, I gotta go through this. Regarding doji, it indicates reserve. Yes. So Ruru, a doji to me, a daily doji especially, is really indicating that you've got a lot of buyers, you've got a lot of sellers, and they kind of meet in the middle. You're not going to always get. This is a pretty. Well, here's a pretty perfect doji, right? You got a lot of buyers, you got a lot of sellers, indecision. They kind of balance each other out. So when you balance each other out, sometimes you'll get daily doji followed by essentially what turns out to be you were wrong. This was not a downside entry. So if I'm late by a day, I wait for the confirmation on the next day. You got your daily doji confirmation. Okay, we're moving down. And this could have said, this candle here could have said, get out. You've had profits, get out. And anybody feel free to hop on. Let me know if I'm not clear, if I'm missing something. But going back to the original content here, Heikin Ashi is not ideal for drawing supports and resistances. The way the candles are calculated, for example, I'm going to place my cursor here. And we're going to see that we have a huge wick on this candle. On this candle body, right? If I flip back and I'm going to place a line at the bottom of the candle body, I'm going to place a line at the bottom of the wick. If I go back to traditional candles, it doesn't really turn out to be that way, does it? It looks much different with traditional candles. So when charting, please don't chart with Heikin Ashi unless that's all you're ever going to look at, because things become very muddy when you mix the two. So flipping back here to the presentation, charting methods, we're looking for multiple touches, go from large time frames and refine it over time. We've learned how to apply it. We've learned really what to look for. We've learned the methods on keeping it simple. The one thing I didn't touch on that I should is when I'm getting down to like 6-minute charts here, I've run out of colors, right? I only can go so light on my coloring convention before things become less apparent. So when I'm drawing my supports and resistances, I use a method. When I draw pre-market supports and resistances, let's say I picked here and here as my pre-market levels, I'm going to make those dashed. So I know when I'm looking at my chart for the day, going into the day, my dashed lines are going to be my pre-market levels. So when I'm trading throughout the day, I know that this level here was essentially the pre-market low. As we broke upwards and broke down, we've got SPY here trying to kind of break up or down. And as your general price approximation, this 423.3 level ends up being kind of where we just move side to side before we finally have this confirmation of a breakdown, right? So if I'm charting throughout the day, I might have said, hey, we've got a breakdown here. It found its bottom here. And I'll place lines throughout the day, leaving it as this dashed yellow line, knowing that I can carry them going forward, but those are all intraday or pre-market levels. And usually with intraday, I'll go from dashed to dotted, just again, so I can keep these things clear in my mind. So as we chart throughout the day, we have a breakout. Hey, look, it has now met that pre-market low, which it treated as essentially an intraday high before it started to break down. So these are all things to look for. There are certain days where it's going to be prettier than other days. they're going to be, and if you go to my charts, I typically leave them on until I find them no longer relevant. So if I look at SPY on, well, we're running a little slow here, but if I look at SPY on my charts, it looks very messy. But using all these different coloring conventions and things like that, I know exactly what's happening when I'm looking at a very fine chart. My computer doesn't like live streaming at this time. So now you're looking at exactly what I did in that day. I've got this pre-market low, and I might not have. I know I didn't trade SPY on Friday, so there's no real levels to look at here. I took longer positions on SPY, but I wasn't ready to trade zero DTEs on SPY on Friday. So yeah, these are. Here's an example of a 390-minute support that I had drawn at some point in time that played out on Thursday as a support, as a bottom. Flipping between normal candles and Heiken Ashley. So Ruru, for day trading, I will not use Heiken Ashi. It's too muddy for me. I've committed to using traditional candles, so I don't use. And the other problem with Heiken Ashi is that it covers up gaps. You know, the true price action on SPY pre-market was a gap. If I pulled up Heiken Ashi, that doesn't look like a gap. So you don't necessarily get to see those things. So it can be very misleading if you don't use them. If you don't commit to using, I'm going to call it the appropriate candles for the appropriate application. Glitterbeard, I wish I could connect my broker to my trading view.
That would be dope. Basically, a question. So sometimes Jordy will draw supports just based off like single wicks that he'll see in pre-market. I don't know. You can look at that long green wick. I guess sometimes he'll draw like a line on that and be like, this is the pre-market high. You know, he'll say like if it breaks that, then we have a chance of going somewhere. Is this something that you consider valid, just based off like a single or a couple wicks, or do you look for like a lot more? Do you look for bodies mostly, or do you look for, or are you including like double taps on wicks?
So
strong support.
I'll use both wicks or bodies. Again, because I treat them as general approximations rather than finite numbers. So you'll see, I don't know where I believe this 422 was drawn prior to Friday or prior to Thursday. But carrying it going forward here, it's a general approximation of where we're getting touches, right? I've got some bodies and I've got some wicks. And the reason I do that, again, going back to the PowerPoint, is we have three kinds of touches, right? We've got pinpoint touches with just a wick. We've got Pearson reversals where you'll get a body and then a wick. And it's tough because of where a candle may or may not lay in time, which is why I think the argument of candles versus, candle bodies versus wicks is a little irrelevant, because the way that a candle is formed is like on a selling candle, we know that it started at the top of the candle, right? And it ended at the bottom of the candle. And at some point in time, during that 6-minute period of time, the price went down to here. So that's not necessarily saying that, well, in this 6-minute period of time, they decided it was worth this. It's just how the price action occurred. So to suggest that only wicks matter or only candle bodies matter, to me, seems inaccurate, just because of how candles are calculated. Like if FOMC minutes released at 2:01 and 15 seconds versus 2:01 and 30 seconds, the candle might look differently, and those preceding candles might look differently, just based off of time. So
you said you usually work from the larger time frame down, right?
Yes. Yep. So Jordy might have a method for using these. I call them ghost wicks. It would be one thing if it came on a ton of volume, I might pay attention to it. But the volume on that candle is really no different than any of the preceding candles. So to me, it's not necessarily that substantial. If that came on 3 million volume pre-market, I might pay a lot more attention to it. But to me, that just looks like a ghost wick. And the other thing I would like to point out, again, just using kind of increasing the number of tools we have in our toolbox. I guess, so if we want to look at it in terms of like institutional buyers, they're kind of like Superman. They've got all the powers, right? Whereas retail traders were kind of like Batman. The best we've got is what the tools we have in our toolbox. So being able to reach for more tools it makes it a little easier on us. So one of the last tools I'd like to touch on is going to be gaps. And it's going to take me a second to pull this up. Because
if you want a really good example for support and resistance, you should look at SHOP for the last couple of months. It shows really good SHOP for resistance.
So, are you trying to upset me, Europe, since I'm way down in it?
I mean, I try to tell people when
trying to get your upset that I have
we're hanging around 40 and trying to break them up. I was like, hey, keep an eye on that because, if you get stuck in this like 40 to 30 range, and then, sure enough. But anyways, either way, that shows crazy strong support right now and resistances. You can almost play those back and forth at this point.
So the last one I use is for gap fills. Gap starts with a G. It's a gray line for me. I know that if I'm ever looking at a chart and I see G, it means it's a gray gap fill. Whatever. So we're looking at here is that BABA on the 1 day has posted a gap fill. We know that historically 91.4% of gaps get filled. So we see here that we have essentially a gap on the daily, and you can confirm that. But what I'm looking for is, again, just making it easier as a trader. What's on the right? What am I looking at? We got these gray gaps. So we broke down here, broke up, and essentially what we're looking for is a gap fill. So we have a gap from this bottom of this wick to the top of this body. And what we did was we filled that gap right almost perfectly to the top of that body. So you said shop. I am zoomed way in. Yeah, there's an excellent example of how, shop found support. I'm going to
check it from May. Blow it up from May. You can see it's stuck at basically a rectangle bottom. It tried breaking out, but it got slammed back down.
So yeah, if we wanted to look here, we've essentially got very strong support. We've got strong daily support where it tries to break out, really can't. It's holding this line, and even though we have some breakdowns, we have again a Pearson reversal. We've got a couple different types of price action here. Shop's holding this support very well. So what did I do? So looking at this this price action here, it's reasonable to assume that if this downward trend continues, what would be a strong buy zone? It's reasonable to assume that 31.21 is going to be your buying opportunity.
Exactly. And if you're looking at the top of where it's been doing, it's been hitting like, what, 40-ish before it rejects? And it tried breaking out recently, and, Hal and I were keeping an eye on it real close, because I was telling him, I was like, I want it under 40-something, 39-something to short it again.
Yeah, and then so I've got some great examples. I mean, if you want to look at something, not to be confused with the S&P mini futures, but Eversource Energy, which used to be my power provider, and having used to work in the energy business, it was something I used to like to look at. Here's a beautiful example of how closely can support and resistance really hold up over time. And this is a 2-year trend of we've got support and resistance on a daily level. It's very clear where this is going to move around. And another one, power companies. And this is something that's really good to address now. Support and resistance does not always occur on a horizontal plane. Support and resistance can frequently occur in an XY axis. So using, again, your TradingView tools, I have my quick toolbox already pulled up here. If you want, you can just go to the left-hand pane and you can drop out trend lines. So if you click the star next to it, it'll save it in your toolbox right here. But if you pull trend line, and you kind of get used to how these will draw out. So on a daily chart here, and you can refine it more. But again, just to get a general idea of what the trend line can look like. So something that I love to do is you can develop your own channels within TradingView. So if you click on your trend line, you'll know it's selected based off of the blue dots, and you've also got this zone picked out. If you just Control-C, Control-V, so you're copying and pasting, it gives you the same exact trend line at the same exact plane. So you can develop your own channels. So now that I see that, I've got a general approximation of a channel that I've developed on my own. You know, you can use the channel tool, but using their channel tool for me feels a little clumsy. This is much quicker. So now we've got support and resistance on an axis. We've gone from horizontal support and resistance, and again, same thing. We know that based off this price action, okay, now we've drawn a line. You can extend that line. And it treated that as a support. We broke down here, and then we eventually came back, and it acted as support here, support here. And if I zoomed in, you can probably see it acting as resistance a couple times. So again, this is what I was referring to as when a support resistance or a trend line behaves as both support and resistance, it becomes more substantiated. I apologize if you hear one of my dogs in the background barking.
Yeah, I mean, that's really unprofessional, Marker. I would never let that happen.
I know, it's incredible, right? The audacity of my dogs.
Somebody barks every time.
So there's lots of different ways to use support and resistance. Trend lines is a little bit more finessed, and it becomes a lot easier to identify those supports and resistances after you've gotten really practiced at it, doing the horizontal line. You know, just using your hotkey, use Alt-H. You can drop supports and resistance all over. Stop that. So you can start, once you get practiced at it, doing it just this way, it becomes easier to start to identify them on altered axes. So I'm going to go back to my guideline here, see if we've gotten it. So yeah, this is what I was going to talk about: non-horizontal support and resistance. Probably the most famous, if we want to look at it, and it's a very clear one. So this would be a good way to summarize is SPY, right? After this, I don't know what I was doing here. So we had the infamous SPY channel that lasted a long time. So we can draw essentially the bottom of our channel here, right? And again, using that same tool, Control-C, Control-V, copy and paste, we can place the top of a trend line. And this was, you know, there were attempted breakouts on the daily before it came back down. And on these larger time frames, these channels, these trends can become more loose guidelines than anything else. You know, if you watch it break out, it's a general expectation that after being in this channel for 5 months, that it's going to come back down. Before it, you know, it did. It returned to this channel, and we had a daily breakout or daily breakdown before coming back up and returned to this channel. So this was, you know, it's a very obvious one. But if you do this throughout the last 30 years or 40 years, or how much data you can get from TradingView, you can apply these channels to SPY all over the place. You can do it here, you can do it here, here. So you can start to really get a sense of maybe what is the market doing overall. And even here, you can see that we might potentially be developing a channel, although that looks more like a vertical line. But, you know, there was a downward channel to follow here where if you saw a breakout, it's reasonable to expect that breakdown. I like NEE for electric sector. Opinions on it too. Yeah.
Ethan?
Yep. What was that, Carrie?
Can we go over a couple tickers?
Absolutely. Yep.
So the two I wanted to go over were, one, I wanted to look at XLE.
Okay.
Thinking about taking a position in that. And then the other one, I'm thinking about, not only am I going to put in the DD, so I guess you'll be doing it anyways, but it'd be nice if you could break it down live.
Sure.
I'm probably going to take a position, no, I am going to take a position Monday in Nordstrom, because they always kill it on the week for earnings. So
Sure.
I'm going to take a swing on them.
So we will pull up.
I like Nordstrom.
You know why you like it? Because I told you last earnings you didn't take it and you were dying.
No, they take it.
Did you? Oh.
So-
Dicks we didn't take.
XLE.
So yeah, I'm thinking about getting some contracts in XLE, like longer out. So can you run through how you would look at that? So if
Sure.
I said to you, hey, if I texted you and said, hey, I'm thinking about getting some leaps at XLE, let's break down what you would look at.
So I'd start on the 1 week. XLE has not been around that long. Wait, since '99. But on the one, and I like to do. I typically will blast through these longer time frames. Whatever. I don't know why I have that on there. I like to blast through the longer time frames pretty quickly, just because it's again I know that I'm treating them as general approximations, so I don't need to be that precise. But going through my method here, I'm going to start with the darker line here. So I've got a touch here, a touch here. I see that there's some general price response here before I move up to the next level here. And again, I'm basing that off of, I've got a few touches here. I've got a few touches here. And these are 1 week. This is a 1 week support or resistance that's held up since 2005. So that, we know that's a pretty substantial level, right? And again, we see the price action and the price response. And you can move through this pretty quickly on this 1 week, especially when you're dating back levels to 2005, 2007. So just popping these through, there might be reasonable to think that this might be a zone of support or resistance. And we're going to go to the 1 day real quick. And looking at the 1 day, I'm not going to look as far back on the 1 day. I'm not going to go back to 1999 with that one. But looking at the 1 day, I see that I've got a few key touches here. Just looking at here, where did I just draw that line? Sorry. So I'm going to recolor that line before I lose it. I've got a couple touches here, 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 here. We came close to that line, so there's probably going to be either a 390 or a 195 minute line here. But we know that it's close, but it's not touching, so we're not going to worry about it too much. Going into the 390. And I don't know if my chart looks as laggy to you as it does to me. So going back, I'm going to have to scroll back a little bit. On the 390 minute chart, we can see that there is some general zone of approximation here. And I will show you in a second where that came from. So I see that I've got some response here, but really what I'm looking at is I've got a touch here, 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 and all this way through. So if we were drawing this line pretending that this doesn't exist, right? We know that this line coming from July of 19 all the way through October of 20, this held up as a 390 minute support. It acted almost as resistance right here. Going forward to today, it acted as resistance in October of 21. So that kind of shows the relevancy of these levels over time and how we drew this level back from 1999 and it acted as support. I mean, we had a very, very acute response to that price level here in July. So it shows how important these levels are to draw, especially on these dailies where you're looking at, I'm guessing, a swing trade in XLE. These become fairly important numbers. So again, we're going to drop to the 195, and we're decreasing our time in half here each time. And typically, as I decrease the time frame, I also decrease how far I look back, especially for these quick charts. If I want to do something like an Apple, I did incessantly. I was obsessive over how thoroughly I charted Apple, and I went all the way back to the beginning. And I have each key level charted on Apple. But so for the 195-minute chart, I've got 71.55 based off of this rejection here, this support, a Pearson reversal here, a pin touch here, pin touch here, pin touch here. So we've only got one. Looks like we have some responses here on the 195 at 46.09. Not that I expect it to go down to 46.09, but knowing that that key support is there, right? And if there was ever a split or something like that, it's reasonable to expect that these prices, let's say XLE did a 2-for-1 split, from 78 to 39, all of a sudden we'd be in the zone where 46.09 would play out again, 37.76 would play out again. And we saw that with NVIDIA after their split, and we saw it with Apple and Google just recently. So going to the 95.
Ethan,
Yes.
let me ask you a question. You're looking at the higher, the 97, 195 time frames, and you have this zone that it's currently in. The last time we got a finalized pump to the upside, and you may be able to go back to when oil ran in 2004, 2005. Where we got this, $92 top. Do you think that it's going to play out between the 71.65 and the 79.40 to maybe create a triple top and have that back and forth over the next year before it does finally break down and move to the downside? Do you think that we'll only got the first top in this move and there's still a couple more tops to go?
Yeah, so that's one of the things I do is once I've kind of just quickly drawn out these levels, I'll go back and look at. So ultimately, we saw that this 78.94 is played out essentially as you want to call it a triple top or a quadruple top here before breaking down. So looking at how things have historically reacted at these key levels makes a difference. It lets you predict how they're going to play out in the future. If you saw that we had a quadruple top here once upon a time across a period of 4 years, it's reasonable to expect that if we've seen a double top already form at 78.94, that a triple top may very well appear as well. And you'll see that historically with certain tickers, tickers that have been around longer. You look at Apple, you look at Microsoft. Those are the tickers where it really plays out over time, where those repeated triple tops, if it breaks down or breaks up, you might see a double bottom there instead. That kind of repeated price response is pretty common. I'm going to drink some water here. So anyhow, looking at XLE, we had this sharp and very acute top here, and something I do occasionally just when looking at something briefly. Didn't want to do that. Is I'll place just a little notation, and I usually put it in green or red or something like that, knowing that. So if I have a green number over here, that's just a local top I have, and it's rough. I don't try to make it perfect, but I know that's just going to be a rough top. So we had a very acute price response here before breaking down, where we found support at. I'm on XOM. Jeez, this doesn't look familiar to me all of a sudden. So we had this very acute price response here. So that could be what, if we see a break upwards here, we could be looking at either a double top or, again, really watching what volume does, and the length of the candle bodies should indicate what you're expecting to go through. If you're going to see a breakout, if you're watching price start to taper off here, volume and candle length of the candle body to taper off, it's reasonable to expect that you're going to see a breakdown here. So anyhow, looking at XLE, I might even go so far as, I see a trend line here. I might extend it a little further out. And I like to take these trend lines and extend them out. I did this a couple times with Apple recently where I said, hey, look, there's a trend line that I have on the daily, and I'm watching for this to play out on intraday. And sure enough, it broke down, and then it had a very sharp breakdown there. So I have this daily trend line here. I'm going to copy and paste it, please. And I'm going to see if I can make it. Yep. It looks like we can make that as a general approximation again. I'm not expecting precision, but I am expecting a general approximation of what kind of channel is this operating in. So we see that its axis resistance here, we essentially have it exacting as resistance here. So we're kind of banding in this channel here where we have a breakout, and essentially you might be able to say, well, it's no longer relevant until we come back down into this channel where all of a sudden the bottom of the channel plays out again. And it plays out very closely from these 3-4 touches. And now we've got yet another touch. We've got a 5th touch. So coming to the top of this channel at, let's say 84.2, 85 may be the top for an XLE swing to the upside before coming back down. And what I'd love to see is when you have these strong points of confluence, right? You've got a weekly support, or in this case, we're probably looking at it as a weekly resistance, followed by resistance on the top of this channel. So if the trajectory was not so vertical, but was rather less inclined than a vertical response, you could be looking for a rejection here at this 88.4 before coming down. And then this is where it really becomes important of, am I looking for the horizontal or the inclined support? Because you've got supports and resistances within these channels, and they still play out within them before essentially returning to one or the other. And again, you can make your determination of, is it going to be the 71.55 that I see here, or is it going to be the bottom of the trend line based off of what is volume doing as it approaches that level? So we can see that volume tapered off before coming back up.
And just so you guys understand how to kind of use this for your trading, what will happen is you will see as it is progressing up the channel, right? It's laddering itself up to hopefully a top of 92.8. These time frames are going to give you the opportunity to make a decision on whether to cut a option contract or a stock position or dollar cost average, right? Because a lot of times we don't want to take the DCA until we have a reason to take the DCA. We've had some members that have DCA'd for the sake of DCAing, and we don't want that to happen. So when you look at the shorter time frames in conjunction with the longer time frames, when you have your channel build across all time frames, you'll be able to understand when it's to, we're playing this trend line out to get that. We know that 7155 is a key demographic for this particular entity along this time frame, and we can go through other time frames to make sure that demographic remains the same, and that's really gives us the opportunity of when to dollar cost average or lever up a little bit more and try to figure out how to take a trade. That's just how I do it, at least. So just I didn't mean to interrupt there.
No. So this is pretty much the conclusion of what I had.
It's awesome. I'm gonna have to listen to it again.
It was recorded, and we'll have this uploaded. I am sure there are things I bowled over in this, and I'm sure, after I go back over it, I'm going to say, oh, why didn't I say that? But please, if you have any questions, if you have any chart requests, put them in #chart requests. If you have any questions, feel free to reach out to any of us. We'll be posting this, and I hope it was beneficial to everybody. I hope somebody was able to glean something from it.
Absolutely, it's great. Yeah, good stuff. Thanks, brother.
All right, guys. Thank you so much.